This liquidity trading strategy never fails me, and after 4 years of trading, this is the only thing that's made me consistently profitable. And once you understand it, it's an absolute moneymaker. It's simple, it's easy, and most importantly, it actually works. I've given this model out to thousands of students, and it's finally been the turning point in their trading. So hopefully, in this video, it's also going to be the turning point for you in your trading. So I'm going to explain what this model is, and more importantly, how you can use it today to start making money. Okay, so the first thing you need to do for this model is you need to identify where the most obvious liquidity is, right? And to do that, you can use the higher time frames ideally, but for this model, I'm going to show you a quick and easy way of determining the most obvious liquidity if you're a day trader or scalper. So you're going to use the 15-minute chart, right? And you're going to zoom out and you're going to look for the most obvious highs or lows. Now, I hope it's pretty obvious, and I've marked it out for you. I hope it's pretty obvious. We've got liquidity here, here, here. We've got almost triple highs on gold, right? There's lots of liquidity. There's lots of stop loss orders at this high here, right? So we just mark this out. Lots of liquidity, which is just another way of saying stop loss orders. So don't get confused by the terminology, right? That's all liquidity is. It's just stop loss orders, right? Right here, there's so many people shorting gold, hoping, this is all-time highs, right? And they're trying to ride gold down, and they see a bit of bearish movement here, so they're even more confident. As price comes up, more and more people are shorting, hoping, right? They're hoping that price is going to come all the way up and bounce back down. Now, if you've been trading for any length of time, you'll know that price does not bounce at random support and resistance levels. What will happen is, if we are bearish, price will come up, it will take out these stop loss orders here, and then it will start to reverse. Or what could happen is, if we're bullish, right, if we are bullish, price will just smash right through these levels, right? If you notice, in both scenarios, both bullish and bearish scenarios, price is going to move up towards this key high, right? Now, what we do at that level, whether we reverse or continue, doesn't matter. All we need to know is that price is going to move towards this key level here, right? Because there's lots of stop loss orders. That's all we need to know. Now, you might be asking, why do we need to know that? Because that gives us the overall direction of the market, right? That's the only reason we use liquidity. Very, very important you understand that. We don't use liquidity for anything else apart from giving us the direction of the market, right? Liquidity is not for your entries. Liquidity sweeps, which we'll talk about later on, that is what you use for your entries. So right here is our liquidity. That tells us that we're bullish and that we're going to take out these highs, or at least we're going to trade in that direction. So what that means is, when we get on the 1 minute or 5 minutes to look for our entries, we're only going to look for longs, right? Very, very important that you understand that. Lots of people, they don't understand why we actually use or care about liquidity. The reason we care about liquidity is because it gives us the direction of the market. That's it. That's the only thing we care about, is a direction. Because if you don't have a direction when you're trading, you're gambling. You need to have a direction. You need to have at least, some logic or confidence of why price is going to go in that direction. So we know lots of stop loss orders here, lots of liquidity, very, very likely that we're going to trade in that direction. Okay, so now for the fun part. We've got our direction. We know that liquidity is all the way up here on the higher time frames, right? That's where our direction is. That's where price is most likely to move. So I'm now on the 1 minute chart, and you can use it. Someone's asking me, hey, why are you on the 1 minute chart? You can use any time frame for your entries, right? So as long as you've got the liquidity, you've got the overall direction. It doesn't matter whether you use the 1 minute, 5 minute, 15-minute chart, or even the 4-hour chart, right? When I swing trade, I use the 4-hour chart using the exact same logic. So it doesn't really matter what, time frame you use. The only thing that matters is that you've got the overall liquidity, you've got the overall direction, and then that you wait for a liquidity sweep, which I'm about to talk about now. So what a liquidity sweep is let's say we've got the overall direction, which we have, right? We know we're bullish, right? We know that price is going to go towards these highs here, right? We know the direction. Now, most traders, they can understand, at least they can identify where the obvious liquidity is, right? They can understand, okay, we're bullish, there's key highs that price is likely to go towards. But what they get wrong, and what I got wrong for about 2 or 3 years, is I didn't know where to put my stop loss. Because what would happen to me is price would move up towards these highs here. On the retracement, there'd be, let's say, a fair value gap or an order block. I would buy around here, put my stop loss here, thinking I was nice and safe. Price would come down, it would take out my stop loss, and it would go straight to my take profit. Or even worse, it would give an even better entry right here, and it go straight to my take profit, right? That happened to me consistently for years and years and years. And I could get the liquidity right, I just couldn't get my entry right, and I never made any money, and I lost so much money, and I went through so much pain. So I want to save you, I guess, the pain of going through that. And the way you solve this issue, and what I figured out, is you need to wait for something called a liquidity sweep. Now, a liquidity sweep is just a fake move designed to take out stop loss orders. So in this scenario here, we're bullish, right? We're bullish and we're targeting this liquidity pool here. this liquidity, these stop loss orders here. This move here, you see how price comes down, it takes out stop loss orders here, and then quickly moves off in the opposite direction. That right there is a stop run. Now, the reason we know it's a stop run is because, first of all, we know the overall direction of the market is bullish, right? That's the first thing you need to know. You need to know the overall direction, right? So we're only going to look for longs, right? We're forgetting any, opportunity to go short. We're only going to look for longs, right? So price coming down, price being bearish. First of all, we're going to think, hang on a minute, price is actually bullish on the higher time frames. Why is price coming down? Is it to either give us an entry or is it a liquidity sweep? So price comes down, takes out the stop loss orders here. Now, I don't know at this point here, I don't know if price is going to reverse or not. So I'm not buying here. Now, some people, they will buy as price is taking out these stop loss orders here. That is called a turtle soup. So you might hear people saying, oh, turtle soup and stuff. Trust me, do not look at that at all, because that is very, very advanced, right? If you're buying stop loss orders, you need to have a lot of experience. You need to have a lot of experience. Even I, with like 4 or 5 years of trading, it's very, very difficult because you're going to have some big balls to start buying stop loss orders, hoping that price reverses, because if it doesn't, you will lose money very, very quickly. So I always say to my students, wait for liquidity sweep, wait for the price to move off in the opposite direction, in the overall direction, telling you that you are right. Right? That's how we know it's a liquidity sweep. I don't know it's a liquidity sweep here. I only know it's a liquidity sweep as price starts to move off in the opposite direction and ideally starts leaving fair value gap. So I'm going to show you what that looks like on the 1 minute chart. Okay, so here we are, and now we're looking for our liquidity sweep. Now, a liquidity sweep, like we said, it's just a stop run. So at this, I guess this low here, there's lots of stop loss orders, right? Now, the reason there's lots of stop loss orders is because people who were buying gold, let's say down here, there's stop loss orders here. They've moved it to here, to here, to here, and then here, right? Around these levels, there's lots of stop loss orders, right? Very, you all know about trading, trail your stop loss, typical advice, all that sort of good stuff. So at this low here, lots of liquidity, lots and lots of liquidity at this low here, right? And if you notice, when price comes down, what it does is it doesn't bounce at this level, right? As typical support and resistance says, it doesn't bounce at this level and then go off like that. What actually happens is, if you remember, I said, when we were talking about the overall liquidity, is if price is going to take, if price is going to respect it, what it's going to do is it's going to take out liquidity first and then go off in the other direction. So what that looks like is, you see this wick here, right? You see this long wick that comes down. The only reason this wick exists here is just to take out stop loss orders. Anyone who had their stop loss orders around this level here, right? Let's say their entry was here, their stop loss order was at this level or around this level. This wick comes just enough to make sure anyone who had their stop loss orders around this general level here, this general area here, that their stop loss would get hit, allowing smart money, those in the know, to start buying, and then ride price in the other direction, right? That is what's actually going on here. So we always need to wait for this wick to take out stop loss orders before we can enter, right? Very, very important that we do that, because that is our liquidity sweep. But that alone is not enough for us to know it's a liquidity sweep. If you remember on the example of the blue lines, what I said is we need to wait for a fair value gap, ideally to form in the opposite direction. We need to see some confirmation that we're on the right side of the market. And what that looks like is we want to see this wick take out stop loss orders and then quickly move off in the opposite direction. And if you look here, price quickly moves off in the opposite direction and it leaves a big bullish fair value gap, which we always like to see. At this moment here, after the wick takes out these stop loss orders and the bullish fair value gap forms and this big bullish fair value gap forms, at this moment here, so when this candle finally closes and this fair value gap's established, at that point only do I know it's a liquidity sweep. Very, very important that you write that down, right? Write that down on your notes. Only after this wick has taken these stop loss orders and the fair value gap has formed in the overall direction of the overall market all the way up here, only then do I know it's a liquidity sweep, right? I'm not guessing, like these guys who do total sweep, I'm not guessing, oh yeah, price is just going to come up, let me just buy here, and then, it comes all the way down here, right? I'm not guessing, I'm waiting for confirmation, right? And that's how we get such a high probability entry. So at this fair value gap here, this is where we're going to enter on, right? You're going to enter on this fair value gap like this, and your stop loss, and I'm always going to say it has to be at liquidity sweep low. The whole point of waiting for this wick was to take out stop loss orders. If you put your stop loss here, right, I know you get away with it in this entry, but I'm telling you, so many great entries, price is going to come down, it's going to tap, let's say, this order block, and then go straight to your take profit, and you're going to be that angry and annoyed. And I have so many students who get literally 9 things out of 10 right. They just can't put their stop loss in the right area because it's probably a psychological issue, right? They're probably just obsessed with such a, massive risk to reward ratio. But I'm telling you, all you need is a 2 or 3 risk to reward ratio with a 50% win rate to be profitable. That's literally all you need to be a profitable trader. So here we go, stop loss at a safe area, nice and safe area. And then remember, this is the 1 minute chart, right? So it's not some crazy stop loss. It's only the 1 minute chart. And then for your take profit, you're going to target at least a 2 to 1 like this, or a 3 to 1 all the way up here. And if you notice, we've also got highs here, right? We've also got highs here. It doesn't really matter because as long as we're trading the overall direction, that's fine. Now, this is really important too, because I get a lot of questions about this. People say, oh, hey Atif, you said, liquidity is up here. This is where price is going to go for. Should I target this on the day? I would say, you get a 1 to 5 here. I would say no, because what could happen, especially if you're a day trader, is price can come up like this, right? So you've got your liquidity sweep, right? You've got your fair value gap. It can come up, like let's say a 3 or 4 risk to reward ratio, start consolidating, and then start reversing, right? In terms of, let's say a day trader, right, for the next day. So this could be end of New York, going into Asia, it chops. And then for London, you get a liquidity sweep. And then in London, it takes it out, right? You don't want to be, if you're a day trader, you don't want to be holding for 2 days or, a whole day. And by a whole day, I mean New York into, Asia into London. You don't want to be holding through multiple sessions because it's just lower probability, right? So you don't need to target the overall higher time frame liquidity. All you need to do is, let's just make this clear. All you need to do is target a 2 to 1, quick and easy scalp, or a 3 to 1 like this, and then just let price do its thing, right? Let price do its thing, right? Typical thing here, price consolidates for a bit. Key thing is you don't panic, right? Don't panic during this little retracement, during any chop. Just let it do its thing, right? And let's see. I think we probably do take it out. Yeah. I mean, who wants to be holding through this, right? Do you know what I mean? As it starts to chop. Right, perfect. I'm just going to pause here. I don't know what actually happens afterwards. I think we take it eventually. But again, do you really want to be holding, for hours and hours and hours as price just chops around at this key level? Right? Do you really want to be doing that? Or if you can just get an easy, free risk reward ratio. I mean, I think it's about an hour, right? About an hour until your take profit gets hit. You risk 1K, you make 3K. Happy days, boys. Happy days. And this model occurs so often. Literally every single day you'll get a sell. On gold, this is very important, right? On gold, maybe not, but if you're on the 1 minute chart, and again, this is why someone was asking me on the comments, so like, hey, how come you're using the 1 minute chart? You say the 5 minute chart is higher probability, which is true. The higher the time frame, the higher the probability the trading is. But on the 1 minute chart, you'll get a lot more entries. So I'm not saying to trade every day. If you wanted to trade every day, you can use the 1 minute chart. I would say for Forex, never go below. And never go into these seconds charts. I know you see ICT and stuff using it, but if you're a beginner, if you're struggling to be profitable, forget about the seconds chart, right? The 1 minute, it should be the minimum that you go to. But I'm telling you, this setup occurs day in, day out. You identify the overall liquidity that gives you the direction, and you zoom out, you get on your entry time frame. So for me, this is the 1 minute. It could easily be the 5 minute, 15 minute, even the 4 hour if you're swing trading. Then you look for your liquidity sweep, which is just a stop run in the opposite direction of the overall time frame. Then you wait for a fair value gap like this to show you, right? You wait for a fair value gap in the overall direction to show you that that was a liquidity sweep. It was a fake move. You enter on the fair value gap. You put your stop loss at the low, liquidity sweep low. 3, you target 2 or 3 risk reward ratio, and you make all the money in the world. It's literally that simple. You apply this on any time frame, you will make money, assuming, of course, that you can fix your trading psychology, because without the right mindset, you will never make money in trading. And it took me 4 long years to finally realize that. But I'm not going to leave you guys on a cliffhanger like that. If you want to fix your trading psychology, make sure you go watch this full free 2-hour trading course where I go in depth about trading, liquidity, risk management, daily bias, everything you need to know, and more importantly, how to fix your psychology once and for all by reprogramming your subconscious mind. And, if you want to work closely with me, like one-on-one, and I'll show you exactly how to reprogram your mind using affirmations, meditations, visualization, all this crazy stuff you don't hear about online. And there should be a link in the comments down below. But other than that, make sure you like and subscribe, and I'll see you guys in the next video. Peace.